Hi, this is Keith Schneider, CEO of MarketCage.com, and this is May 28th edition of Market Outlook. So, quite the week we've had. Really nice bounce after that nasty sell-off the prior week. So let's take a look at some of the details. Well, first of all, as you can see, the NASDAQ 100 just on fire, up over 19% on the year. Russell's barely up only 2%, but net can't really argue with the overall action. Year to date, 3 out of the 4 indices are on pace for a very, very strong year. For the week, we had a pretty strong week, correcting the loss from last Wednesday after the announcement of Mueller and a special investigation of the Russian allegations within the Trump administration. So net, we shrugged it all off. What is interesting is that, look, we've also been able to get a bunch of accumulation days. So over the last 2 weeks, even with the sell-off, you've only had one distribution day, right, which was the big day down over the last couple of weeks. That's a real positive, right? It means the institutional buying still present, a preponderance of accumulation days. The volume is definitely looking better. Overall performance there, can't really argue with the overall scenario in the biggest and most important key equity indices here in the US. So now let's move on to sectors, because that's sort of giving us a mixed signal. So as I pointed out in our text version of Market Outlook, there definitely seems to be confusion between the leading sectors and why they're leading. Now, generally speaking, utilities would normally lag and end up at the bottom of the table because that's a conservative play, right? It's guaranteed money, and it's really a flight to safety as well. So what's interesting, if you can see here, here's the SPY, right? That's our benchmark. And really, it's number 2, or actually number 3, after semiconductors and technology. So in essence, right, for the last 5 days, one of our strongest sectors is utilities, right? Up 2.5%, even outperforming what was the leading sector. So you're getting definitely somewhat of a mixed signal. Now, the other thing is, obviously, retail here, really poor week, definitely in trouble. We did have some outliers like Best Buy, which really roared. It was up 20% or 21% after its earnings report. So it's been able to tackle the onslaught of online. But nonetheless, 70% of our economy is the US consumer. So with retail doing poorly, it's sort of interesting to see that anomaly. Now, the other thing that's interesting is take a look at this. Consumer staples, also very, very strong. So you got a scenario where conservative plays are doing well, along with the more aggressive plays like semiconductor and technology, where a lot of the growth stocks are sitting. So you've got this dichotomy at the new highs in the market. Hence, you've got the big players still piling in, and you've got some other significant players as well not giving up on their bets. And some of the information that I looked at over the weekend shows bearish commitments in hedge funds and short sellers still sitting at pretty high levels considering the market's at highs. So the interesting thing is, are they going to prove out to be correct, or are they going to have to cover, which would be sort of the culmination of a big run-up in the market where they finally capitulate? So only time will tell, but you got these two things playing out, which makes it really interesting and a very technically driven market. So trying to figure out the fundamentals here, I'm finding almost impossible. Look at the facts. Look at what these tables are showing you, what the actual data is. And that's really telling you the state of mind of the market. Okay, let's take a look at market hotspots, which looks at all different types of asset classes and looks at their performance. And what you're going to find interesting here as well, let's give this thing a moment to load. Okay, so what's interesting on this particular table is, of course, one of the things we like to look at is the 6-month leaders. So the biggest leaders, which is interesting because normally countries don't exhibit the same amount of absolute trend strength as, let's say, other asset classes like commodities. But nonetheless, over the last 3 and 6 months, you can see the money's been pouring into Spain, Italy, Austria, France. So a lot of movement in the Eurozone. They're definitely still gaining. Now, the thing is, over the last 5 days, well, Austria finally kicked in, picked up pretty well. Korea, interesting, with the new regime there, that's also up. So this week, pretty much the leading countries like Spain and France and Italy pretty much went on a pause, but you can't argue with their absolute overall strength over the last 6 and 3 months. Now, the other thing to note, obviously, is volatility just getting crushed. Now, you had that huge move on the heels of that decline, so the volatility has a lot of volatility, even though its trend, obviously, over the last 6 months is clearly down. And as you can see, long volatility down 50, almost 54%. That's interesting to know. So, key thing to continue to watch is a resumption of the trend in Eurozone country ETFs. And let's make sure that we keep an eye on that for the following week. Also, additionally, you can see USO oil definitely really weak, down 2% for the week. So continued pressure in the oil markets as well. So there you have the overall scenario, in terms of global assets. Now let's take a look at market internals and interesting short-term pattern in the market as well. Okay, so let's take a look at the S&P in terms of market internals. And as you can see, the midpoint here, which is the zero, right, zero, sort of the 50% level over here, is that you've got moves above those midpoint lines. That is all positive action. Now, the recent decline on up-down volume, which is a very short reading 5-day, is really based on the fact that Friday, the day before a long weekend, often has extreme low volume. So net, we got a nice improvement overall in the S&P 500 in terms of market internals and strength. Now, what is also interesting is let's take a look at the last 2 days of price action. You've got an inside day pattern. So that's sort of compression or a pause on a short-term basis at all-time highs. So, that gives you an opportunity to potentially play it both ways. Obviously, trading in conjunction with the primary trend, which is clearly bullish, a bullish phase, 200-day moving average here, right? Our 50-day is over here. You're above the 10-day as well. So things couldn't be happier in terms of overall trend. So following a move through all-time new highs, which is just above 242, is certainly in order on an opening range type breakout. And you have a really good stop set up at the 2-day pattern low, which comes in around 241. And if you're playing a little bit with a bigger picture in mind, you've got some good support as well at the 240 level. Okay, now let's take a look at the composite index and see if the market internals are strong there as well. And it looks like they're actually just as strong, if not even better than the S&P. So in essence, right, you got a sell-off from less oversold levels. Obviously, with this market in gear, we were up 2.45% or so just for the week. Year to date, almost 20%. So in essence, you've got a scorching trend in the composite, which has components of tech stocks and the semiconductors, which are really on fire. So overall, big improvement, positive on market internals, and things look just perfectly in gear. Okay, let's take a look at our next chart. And that is the new highs, new lows, all 52-week high, new lows ratio. And as you can see here, you got a nice spike up on the move up. We recovered the 70% level. That puts it back in gear as well. So definite improvement in new high, new low ratio. And you got a lot more potential to the upside as well if this thing really decides to go parabolic. And again, you got this nice sort of compression range, which should give you enough power to really have a good move to the upside. Conversely, a failure from these levels, as we pointed out, certainly beneath the 233 level or 233 and a half, could definitely portend to a much more significant downside. But overall, things look like they're definitely positive and in gear. All right, let's take a look at a couple final charts. This is going to be, this is the NASDAQ 100. Interesting on new highs, new lows, not doing as well as the overall market. So you can see you sort of had this decline here, and net we're still under the 70% level. So this is certainly a neutral to a -1 here. So, you know, it's interesting. As we're making new highs, the overall participation not as good as we would like. So, listen, not everything is always in sync. Net market internals still overall a net positive for both the NASDAQ 100, the composite, and the S&P. Now let's take a look at sentiment, and we're taking a look at volatility, the VIX indicator, and look, you had that huge spike. It happened basically in one day. So when we talk about, you know, people looking for the exits and heading for it rather quickly, I mean, this literally happened in 24 to a 36-hour period, and now is back down to virtually the lows. So all you can say is volatility supporting the overall rally, but markets are hypersensitive at these levels based on some of the information that we covered earlier, especially some of the issues regarding some of the sectors that are hot, like utilities and consumer staples. So definitely there is your sort of disconnect or disassociation between the bulls and the bears. So there's definitely that lingering concerns, and of course it's reflected in just how fast this thing moved up and down as well. So again, overall sentiment now in positive mode. We're back beneath the key moving averages and in the midpoint of the Bollinger Band, and basically plumbing the lows in absolute value in volatility, which is a positive. Let's take a look at the ratio between the 1 month and the 3 month. And again, we basically after that shot down on May 17th. We barely touched the oversold levels. We did. We got everything moving up in unison. We're sort of in this midpoint of bullish sentiment, not really at an overall extreme. That's what we need to keep a lookout for. This indicator works best at overall extremes, and then following the price action is the best way to play it. So, extremes down here, extremes down here. And what we like to do is see counter trend moves against the overall trend for opportunities to buy. So trying to pick tops in a rising market above the 200, not the best use of this indicator, using it for potential sell-offs. If we're going to look for a potential sell-off that really sustains itself, we really want to see an extreme blow-off and then a rollover before we act on it. Okay, hope this helps. See you next week, and bye for now.